So the tax laws have changed. Jack, we're here to learn more about what that means for us that are filing taxes.
That's right, Tom. And as we've spoken before, 2018 had presented many challenges because of the new tax law changes. And I know as CPAs, quite frankly, it took us a lot longer to prepare returns, and there was a lot more strategy involved in actually doing them than in previous years.
So you're saying you just can't plug it into the computer anymore and expect the things to pop out like you?
Well, I'm not sure you could ever do that, but because the truth is when people rely totally on software, even though it may calculate correctly, it doesn't necessarily mean that that's the best result. And we found that over and over many times over the years, and certainly with 18 for sure.
So let's talk about corporate returns or business returns, because if people are in business, they have to file a return, and those have changed.
I would say these are the most significant changes to business taxes probably since 1986.
Wow, that's a long time.
That is a long time even for me. That's right. And so I would say the change that affected most business this year, they refer to as the Section 199A. That's actually an Internal Revenue Code section. And in the big picture, what this tax law said is that instead of having to report 100% of your income if you're in business, you only have to report 80%.
Oh, wow.
So basically, you got to deduct 20% of your income. So this is a huge change. And while on the surface, it seems pretty easy to do, you take 20% and multiply it times your income, it turns out that wasn't even nearly the truth, okay? Far more complicated and far more strategy that was involved.
So does that just across the board for anyone that's incorporated, any business owner, did everybody get that 20%? I think you're hinting at here that wasn't just the case.
Well, first of all, I think most people don't realize that 20% deduction could apply to even more than just your business income. So, in fact, if you file as a Schedule C, if you file as a partnership return, you file as a Sub S, the 20% would apply. It also applies to rental property. And you would be amazed how many people miss that 20% deduction. So if you had rental property that had a gain for tax purposes, that gain could also apply for the 20%. And many people missed it.
Wow. You were talking about someone that you did a review on the return, and it can be significant.
Oh, absolutely. A return I looked at and a return my partner Gary looked at, they were off by $150,000 in tax. I didn't say as a deduction, in tax, where people didn't understand how that rule worked.
So you definitely want somebody who knows what the tax laws are, that are looking at your taxes and filing them for you, so that you don't miss out on $150,000.
That's exactly right. And again, I am sure whoever did those tax returns, when they finished those tax returns, they thought that return was correct, because they may have gotten a green check mark on the screen. But like any other software, it's still garbage in, garbage out. And because the input items weren't coded correctly, that's why they missed out on that deduction.
So I'm sure there's other things about corporate tax laws and whatnot that have changed, but let's move on to my personal return now. If I'm owning a business and I'm getting a 20% reduction in income on the business side, doesn't that affect my personal return as well? That's
correct. If you're a sole proprietor, obviously you only have to pay tax on 80%. If you are in business and you file as a partnership or a subchapter S corporation, instead of having the 100% of the income flow through to you, you only have to pay tax on 80%. So percentage-wise, that's pretty significant not to have to pay income tax on 20% of your income.
There were some deductions that were taken away, though, on the personal side as well. Everything's not just rosy every time you look at the IRS. So what happened on the deduction side?
Absolutely. As I used to refer to this as the good, the bad, and the ugly. So there was many provisions that helped people, and there were many provisions that worked against people. And on the individual tax side, the biggest changes that affected people, in some cases dependent upon where you actually lived, because one of the big changes had to do with how much you can deduct as taxes as an itemized deduction on your personal return. People over the years have been routinely entitled to claim mortgage interest, all the taxes they pay, state income tax, real estate tax, and that's been the rule for many, many years. But one of the significant changes this year, caps the tax deduction at $10,000.
Mm.
So, for example, if you live in Nevada, you might be okay because our real estate taxes are pretty low here and there's no state income tax. But you go to take people in California or New York or any state that tends to have high state income taxes and high real estate taxes, and losing that deduction could be pretty significant. People would routinely pay California $50,000 and $60,000 a year and get a deduction for it. And now that deduction is limited to $10,000, so that's pretty significant.
So that could be what's fueling a lot of the exodus from states like New York to Florida and from California to Idaho and Oregon and other states.
I agree. There's been tons of articles I've read where it talks about net population increases and decreases amongst different states. And the last I looked, there was actually a net exodus of people from states like California. And for the most part, they're going to low-income states like Nevada, like Texas, even Utah. Any state that has lower income taxes and lower property taxes, basically you're saving money.
Well, with the new deductions on the personal side, a lot of articles are saying that it's not even worth to claim your mortgage interest anymore on your tax return. Is that true, Jack?
Well, the standard deduction as a give back to losing all these deductions, and by the way, one of the things we forgot to mention too, is that for the most part, most miscellaneous deductions are disallowed anymore. So there's no more employee business expenses or investment expenses. There's no more moving expenses. There's no more alimony. And so now the government's giving you back a greater standard deduction for a married filing jointly. In 2018, it was $24,000. So in order to itemize your deductions, you have to have more than that. And unless you have a really high mortgage, sometimes it's difficult to overcome that 24 because that's what they're giving you for free.
Sure. That makes sense.
But here's the but. When it comes to some deductions, there's a little bit of strategy and maybe doubling up deductions for a year. We refer to it as grouping. So for example, say you wanted to donate money this year, but the amount of money you were going to donate it was so low that even donating it, you still wouldn't overcome the $24,000. Well, maybe now it makes sense, instead of donating it this year, hold off till next year and give them twice the donation.
Mm-hmm.
And so little things like that could make a difference because as of now, going back to your original question about mortgage interest, sometimes it's not worth any deduction at all anymore.
Mm-hmm. So it's not just as simple as checking a box and filing your return or having someone else check the box. It's having people behind you that know the tax law, that can actually look at it and find out how you're going to save the most money in taxes. And that's why you need to call Campbell Jones Cohen and find out what they can do to help you save money on your taxes.